makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. ConocoPhillips is in advanced talks to buy smaller rival Marathon Oil. That's according to the FT, which would extend the rush of major deals in the U.S. energy sector. Meanwhile, mining giant BHP is again seeking more time to buy Anglo-American. The latest Nvidia rally tops $470 billion over 3 days, boosting confidence on AI chip spending, while stocks and bonds retreat after some hawkish comments from the Fed's Neil Kashkari. Plus, while South Africa heads into an election that could reshape the political landscape dominated by the party that Nelson Mandela led to power. So there is a lot going on. First of all, we have a full roundup of what we see in M&A, but this is the market so far. Now, stocks are falling, bonds retreating. Again, there's been a drop in U.S. Treasuries overnight after some pretty weak debt auctions, but also those hawkish remarks from Neil Kashkari of the Federal Reserve. Now, it does seem that markets are feeling some of the ripples from a rough U.S. session this morning. We saw this tepid demand for U.S. note sales, resilient consumer confidence, but also this hawkish central bank talk fueling expectations that interest rates will stay higher for longer. Now, in Europe, what we're watching is, of course, German inflation data and that an important U.S. price growth print in focus at the end of the week. For the moment, it's nothing huge. We're not seeing huge losses, but we really are seeing a little bit of downward movement. And then I would also urge everyone to have a look at, for example, the German 10-year yield at 2.614, and then oil also extending gains as another attack in the Red Sea seems to be adding to heightened geopolitical tensions in the Middle East ahead of that OPEC Plus meeting at the weekend. We're getting German CPI figures. Bavaria, May consumer prices rising from 0.1% month on month. A euro dollar not moving a huge amount on the back of that. But again, we're all waiting with bated breath for that June 6th meeting from the ECB. It's widely expected to cut. And then U.S. futures very quickly, because we did have quite a strange session overnight. If we look at U.S. futures at the moment, you can see they're down some 0.4%. So to market news and actually to corporate news, ConocoPhillips is in advanced talks to buy Marathon Oil in a potential all-stock deal. That's according to the FT. Now, Bloomberg understands that the biggest independent oil and gas producer globally, with a market cap of about $139 billion, has been vying with its smaller rival Devon Energy to acquire Marathon for several weeks. So let's bring in Will Kennedy. He's Bloomberg's senior executive editor for energy and commodities. Well, you can't catch a break. I mean, if it's not BHP, it's now Conoco. It seems that there's, I don't know whether it's a flurry of M&A in the commodity space, but certainly bigger seems better at the moment.
If this deal happens, it's very much in the trend that we've seen in the US oil and gas industry over the last year or so. It follows on the back of bigger deals like the Chevron acquisition of Hess, which was approved by Hess shareholders yesterday, Exxon's acquisition of Pioneer, one of the biggest independent shale producers in the US, and Conoco itself has already acquired assets, buying a company called Concho Petroleum and Shell's shale assets. So the Marathon acquisition, if it happens, very much fits into that pattern. Conoco is clearly trying to bulk up and not catch up, but keep pace with larger rivals Chevron and Exxon, and Marathon, which is 95% a US oil producer, is the kind of company which is getting bought at the moment.
But, Will, so the rationale is that actually there's been underinvestment in certain spaces in oil, and so they can readjust that, or because of the energy transition, they can buy on the cheap?
The rationale, I think, is that the shale revolution, US production, was driven by independent companies over the last 15 years or so. But now we're into a different era where investors are looking for steady, better returns, which involves, I think, consolidation, driving down costs, and that's what we're seeing for a lot of these deals, including the Marathon deal, if it happens.
Well, on BHP, so BHP has asked for more time in this last-minute plea to Anglo. Does that mean that talks are going well if you're asking for more time, or does it mean that they're going badly because you need more time?
I think talks have been difficult. I don't think we're getting diplomatic. I don't think we're getting the sense that there's been huge amounts of progress over the last week. Clearly, BHP thinks that their proposal remains compelling and is very keen that Anglo management engages. Anglo management disagrees. They still seem to think, from what we hear, that BHP's too blasé about the difficulties of divesting the South African businesses. So BHP is basically saying, well, let's give us more time, let's talk about it. They would like Anglo shareholders to put some pressure on Anglo management. But I think we may get an extension, but it's also possible that Anglo, it would be an unusual thing to do, it's also possible that Anglo management says enough and walks away. Deadline, of course, is at 5 p.m. this afternoon.
Yeah, well, thank you so much, as ever, for the terrific briefing. I think marathon pre-market, I think we'll get it up in a second, but it's actually flying off the shelf. Well, not maybe flying off the shelf, 5.7% gaining, and that was our Will Kennedy. Now, the Federal Reserve Bank of Minneapolis President Neil Kashkari has said that the U.S. central bank's policy stance is restrictive, but policymakers have not entirely ruled out additional interest rate hikes. Now, joining us now is Emmanuel Cau. He was Managing Director and Head of European Equity Strategy at Barclays. Emmanuel, thank you so much for joining us. I want to talk about the Fed. I want to talk about inflation and this tilt from the markets, but it feels like there's just a lot of news out there, be it M&A, the geopolitics. Like, how difficult is it to make a cohesive case for what the markets do next, given all of the news?
Yeah, hi, good morning, Francine. I mean, there's a lot going on, and what is surprising is that the market is very, very quiet. Things have been, pretty stable for months, right? You've seen the equity market holding up. Equity volatility is actually very, very low. So the market is actually quite comfortable with the main narrative staying in place, i.e. growth is resilience. Rates are not coming down, but there is no urgency for central banks to save the day. And fundamentals are pretty good. Earnings have been a support to this market despite the broad macro uncertainty, right? So I think what we are seeing is a classic, market trading water into summer. I think clients want to be a bit more barbell and prepare for different outcomes. But I think the main point is that the direction of travel is still, probably a green higher in the equity market, as long as, number one, Fed hikes are off the table, and number two, earnings are staying resilient.
But when you look at the Fed, I need to actually bring everyone up to date. I mean, the pound is rising to the strongest since August 2022 against the euro. So we'll get back to that and whether this is a play maybe on ECB or a play on the UK elections. But overall, we don't really know what the Fed cuts into, right, if it's a recessionary environment. And I don't know whether you feel uneasy. Nvidia is really propping up the market on its own. I mean, it's a single stock.
It's a lot about tech. It's a lot about Nvidia, which has been giving the impression that this market is actually somewhat complacent. In reality, if you look at under the hood, there is a lot of dispersion, right? We've seen in the last couple of weeks a bit of profit taking on cyclical, some defensive rotation. So the move up we had post-April pullback has been somewhat risk-off. Tech has been leading the market back to the highs, but ex-tech, you see more like a defensive leadership. So I think clients are quite cautious going into summer, and we are starting to see, investor bidding volatility and trying to put hedge in place in case something goes wrong, and given the policy uncertainty in the U.S.
But, so do you worry about, if not a recession, a more significant slowdown? And we've seen some data points that suggest that a soft landing may be far off.
Well, look, I think the market has been fully buying into this kind of soft landing script, and I think now people have to reassess the chance of a soft landing. The data has been softening in the U.S. At the same time, inflation is quite sticky, so that's still a very tricky growth policy mix to navigate. I would just say that in our view, which was always the case, the condition for the Fed to cut rate is that you get some degree of softness in the U.S. economy. So far, bad has been good for the market. Softer data has been made by rising equity market because the feeling is that, look, that might prompt the Fed to cut rate and save the day. Well, we are yet to find out whether the Fed can actually act on that and how much pain they need to see in the economy before they can cut rates.
So, Emmanuel, overall, what's supporting European equities? Is it valuations because they've been much cheaper than the U.S. and policy seems to be more of a given what the ECB has said, or is it, again, a play on international?
Well, I think there's a bit of diversification, playing for Europe, which is a much more diverse and broad equity market. But I think the growth policy mix is a bit more favorable than it is in the U.S., right? So you have growth starting to improve, early days, but the data is pointing to some kind of recovery in European data. At the same time, we are quite comfortable with ECB starting to cut rate next week. And this is the first time ECB will be cutting rate without having a recession, right? So it's quite unusual for all of us to see rates coming down, even with growth stabilizing and the market being at the highs.
Yeah, and I have many questions about the cycle and whether once they cut, they continue cutting. Emmanuel Cau stays with us to talk a little bit more about China, the UK, and of course, that ECB cut expected June 6th next week. Coming up, the IMF upgrades its growth forecast for China. The fund now expects 5% expansion, putting it in line with Beijing's growth target of around 5%. Well, the IMF's first deputy managing director, Gita Gopinath, speaks exclusively with Hasland Amin. More on that next, and this is Bloomberg.
China's economy is continuing to recover, so we certainly are seeing that consumption is recovering, but still it has some ways to go. The strength we're seeing in public investment remains. Private investment is still weak, mainly because of the weakness in the property sector. So we are seeing signs of recovery, but yes, there is still more that we need to see more evidence of that. But I think despite that, we do expect that growth will be around 5% this year.
What more needs to be done?
So firstly, I would like to recognize the policy steps that have been taken. I mean, the recent announcement, which involves upgrading equipment of firms, but also consumer goods of households, that can help. But yes, in our view, more will be needed. And so specifically on the property sector front, I think what would be very helpful is to deal with the problem of pre-sold housing. So there are a large number of houses that have been pre-sold but have not been completed. Here, we see a bigger role for the central government to come in and to deal with that, to be able to complete those pre-sold houses. Because when that happens, that's going to help household confidence, which is really essential at this time, and also will help with the exit of non-viable developers. Secondly, in terms of providing support, while overall we think that there should be a fiscal neutral stance, I think it is important that the spending goes in the direction of helping low-income households, because they are the ones who are able to consume more of that additional income, and that will also provide a boost to the economy.
Well, that was the IMF's first deputy managing director, Gita Gopinath, speaking exclusively with Bloomberg's Hasland Amin. Emmanuel Cau from Barclays is still with us. Emmanuel, we're talking a little bit about how tech is actually supporting this kind of market, what the Fed does or doesn't do in terms of cutting interest rates. But the U.S. and China is ratcheting up tensions, and Europe is kind of left in the middle. What kind of China economy are you expecting, and what impact does it have on European equities?
We expect a 5% growth China economy, right? So which means that to get there, they need to do a bit more to provide stimulus. You know, right now, if you look at the incoming data, it's tracking sub 5% growth. So we expect a bit more pro-growth policy announcement. And I think the plenum that will take place in July will be quite important. The Politburo meeting last month was a bit more constructive, with China talking about infra spending, some support to the housing market as well. Look, no bazooka in sight, definitely. So we're not talking for a significant stimulus that would be a game changer for market, but enough to provide some stability to the market. And we've seen to some extent in the last couple of weeks, the Chinese equity market doing better, commodities, copper price in particular, iron ore stabilizing, mining stocks in Europe starting to perform. So there's a bit of green shot emerging in the China economy, and the market is starting to look at the positive as well. Bear in mind that people are being extremely bearish on China. Yeah. So to some extent, maybe the risk reward there tactically is not that bad.
Emmanuel, one of the questions is, are we actually importing stagflation from China? I mean, is that something that, that the question is going away? Also because PBOC and other policymakers have stimulated the economy as much as they could.
Well, I mean, clearly the lack of growth in China has been an issue where domestic demand was pretty weak in Europe. I think there's a question on what happened next year. I think in the short term, you can say maybe there's a bit of stimulus, a bit of momentum in China. The base effects are very easy. The question is what happened after the U.S. election? Do you have a new U.S. administration that could be much tougher on China? Are we going to see China starting to, push harder on Europe and export more deflation in Europe? So I think the politics will be quite tricky there, and I think Europe will probably have to do something to tackle this, China pressure and competition.
Emmanuel, so we're expecting the ECB to cut on the 6th of June, so next week. What happens? First of all, is there a chance that they don't cut?
Of course, there is always a chance.
But they've telegraphed. I mean, the market's priced in. It seems very unlikely, right?
It seems very unlikely. I mean, the last big thing today is the German inflation. We're going to get midday. But look, if you look at the ECB talk has been extremely explicit about June. We don't think they will do another cut in July, but we think June will start the easing cycle. 3 cuts this year. Look, it's quite unusual for the ECB to cut without a recession and with the equity market at a high. But look, it's very much about inflation. Inflation is getting back to the target zone, and that's, basically pointing to better growth policy mix for Europe, right? The growth is holding up or somewhat bottoming out, and at the same time, we expect some additional support from a lower interest rate for what is a very rate-sensitive economy we have in Europe.
But so when's the next cut? So they cut, so let's say they cut next week as telegraphed and expected. Do they wait until the end of the year? And again, we haven't really been in a cycle where it hasn't been cut after cut after cut, as you say, because in the past there's always been a recession.
So there is no need to overdo it. And I think data dependence also matters for the ECB. So we have 1 cut in June, 1 cut in September, 1 more in December. So 1 per quarter into the end of the year. Probably enough to provide some support to the economy. But again, I think what the ECB is going to be doing will be somewhat driven by what the Fed will be doing. And if the Fed cannot cut rate, or not much this year, it's hard to see the ECB really moving away from that and getting much more aggressive. They need to provide some stability to the currency as well.
And for Europe, how do you build your portfolio? I know there was so much talk about, possibly like European luxury taking the space of what the tech is for U.S. markets. But again, we've seen quite a sharp slowdown in a lot of those stocks.
But we think the hot place to be is probably the banks. I know it's very counterintuitive because in theory, if rates are coming down, banks should make less money. But to me, rate cuts are a needed condition for banks to be getting more support from better economy, from improving credit condition, loan demand. So yes, margins might be peaking, but credit volumes might be improving. And we think banks ultimately can still make money if rates are coming down, but not too much. So this is the best of both worlds with banks. Lower rate, but not too much, and still a resilient economy.
Emmanuel, thank you so much. Emmanuel Cau there stays with us. We'll talk about the UK next. Now, plenty more to come, including our coverage of the South African elections. You're looking at live pictures of President Ramaphosa. Of course, our Jennifer Zabazaja is on the ground. We'll talk about what this means for not only the elections, but asset managers and South Africa for the future. This is Bloomberg. So the first opinion poll since the UK Prime Minister Rishi Sunak called a general election, so no clear change to the electoral picture, with Labour still holding a firm lead at 23 points, up 4 percentage points compared with just a week ago. Now, meanwhile, the Labour leader Keir Starmer has pledged to halve the NHS backlog in 5 years if his party claims victory by spending $1.7 billion on a raft of measures to slash patients' waiting list. Now, we're also getting a bit of markets news because the pound has risen to the strongest since August 2022 against the euro. We're back with Emmanuel Cau from Barclays. Emmanuel, I mean, the polls aren't moving that much. I know we're 50 days until the election. But actually, in terms of policy, whoever becomes the next prime minister, and it's widely expected at the moment to be Sir Keir Starmer, is that they don't really have that much fiscal space. So I don't know what it means for market participants and assets.
Well, I don't think it means much. I think at the margin it means maybe less uncertainty. So, we've been having a fairly unstable and uncertain political environment in the UK for some time. And I think global investors lost faith, lost confidence in the UK. So I think if we swap long-term uncertainty for maybe short-term uncertainty, but ultimately less uncertainty down the road, I think that would be quite a good thing for UK assets. And that's how we are seeing, the pound rallying. I mean, on top of, maybe the Bank of England being a bit more hawkish than the ECB. But I think there is maybe some expectation that the UK market gets a bit more investable if we have policy certainty and less political uncertainty.
I guess, the question with the market is that it's so commodity rich. Is this a play on China, on the green transition, because they have copper and they have a lot of oil, or is that actually UK-based companies that will actually outperform?
Well, we think this is more the latter, that, FTSE 250, domestic exposed companies, smaller caps is maybe where you want to be. Firstly, because they're extremely cheap and under-owned, and secondly, because they might benefit from maybe a bit more pro-growth, pro-consumer policies, and there's a Labour government. Again, it's very much about investors getting more comfortable to own UK assets, and if they do, I think they will go to the more cheaper under-owned domestic part of the market.
Are you comfortable with the policies that Labour had? Do you feel like you know enough of what Labour will do if they come into power?
Well, the manifestos have not come out yet, right? That's why the polls, which are still extremely, in favor of Labour, can change. Look I think on paper, we're having a fairly centrist, more business-friendly Labour, party. So I think that's what matters for market. We are not having some fairly extreme left-wing policy that maybe in the past were a concern for investors.
And what does this all mean for Bank of England? They're in a self-imposed purdah, which means that we don't actually get any speeches or public-facing until after the election. I mean,
firstly, inflation is too high for the BOE to cut. That's why June is off the table. So we think August is probably possible, but beyond the election is whether inflation makes enough progress for the BOE to cut rate. We think they will do it, but probably late summer, not early summer.
Okay, Emmanuel, thank you so much for joining us. Emmanuel Cau, they're Managing Director and Head of European Equity Strategy at Barclays. Now, coming up, polls are open in South Africa's crucial election. We're live in Durban, one of the key battlegrounds with the very latest. We look at FX, we look at some of the opportunities in South Africa going forward. This is Bloomberg. Well, Marathon oil shares rise in U.S. pre-market on an FT report that ConocoPhillips is in advanced talks to buy its smaller rival. Meanwhile, mining giant BHP is again seeking more time to buy Anglo-American. The latest Nvidia rally tops $470 billion over 3 days, boosting confidence on AI chip spending. Stocks and bonds retreat after hawkish comments from the Fed's Neil Kashkari. Plus, South Africa heads into an election that could reshape the political landscape dominated by the party that Nelson Mandela led to power. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, voting is underway in South Africa's most consequential election since the end of apartheid. Well, Bloomberg's Jennifer Zabazaja is in Durban, a key battleground for the governing ANC. Jen, good morning. So what role will the economy actually play in the mind of voters today?
Yeah, good morning, Fran. I mean, voter discontent is really at the heart of a number of what voters are going to the polls to today, and especially, as you mentioned, the economy. And if we just take a look at what this economy has done over the past few years, this year it's only projected to grow just above 1%. We also see unemployment at about 33%, a lot of those being young people. And also we have seen issues with electricity outages, which we call here load shedding. Port and rail and freight have been dilapidated, especially here in Durban, where I am, that houses sub-Saharan Africa's busiest port. And so the economy is really at the heart of this vote today, not just, dinner table issues, but also really things and issues needed to get this economy stimulated again. And the question is, will the ruling ANC be able to hang on to that outright majority and continue on with their policy continuity, potentially to the hopes of some investors, or will we see potentially a coalition come in and some different policies being instituted?
So, Jen, talking about a coalition, why are South Africans so nervous about that possibility?
Well, it's interesting, Fran. I mean, if we take a look at just Durban in particular, again, where I am in the province of KZN, KwaZulu-Natal, which for many, many years has been an ANC stronghold. You can see behind me there are a number of ANC supporters here. But in this election alone, we have seen former President Jacob Zuma's party, the MK party, potentially splitting the vote. And also the IFP, which has been here since the dawn of democracy, potentially taking what is one of the biggest provinces in this country. And at the local level, we've seen a bit of instability when it comes to coalition. So the question is, will that continue on a national level? We actually talked to one former ANC member yesterday about this, and this is what he told us.
If you look at there's several provinces that the ANC is in danger of losing. Mm-hmm. The most important one for them to lose is Gauteng, which is the heart of the economy. The second province that they will lose or should lose is KwaZulu-Natal. If KwaZulu-Natal is lost to the ANC loses nationally because that's where it gets most of its votes from.
Yeah. And that was Zaki Ahmed, who used to be a member of the ANC. He's now running as an independent candidate. And as he was just explaining there, Fran, this province is one of the three biggest for the ANC. Will they be able to retain that 50% majority or marginally lower? And if not, what does a coalition look like? What does a coalition partner look like? And of course, then, what does any sort of reform, especially reforms that are needed to get this economy stimulated again, what does that look like going forward?
Jen, thank you so much. Jen Zabazaja there in Durban. Now let's get more with Nomathibana Okello, Portfolio Manager at Terebinth Capital. Thank you so much for joining us. I mean, there's a lot of concern that actually the ANC will have to share power that could lead to more instability. What are you looking forward to in this election? What does it mean for markets and portfolio managers?
Well, thank you for having me. I understand the fear around coalition governments, but from a South African perspective, we've seen how the ANC leading up to the elections, a lot of reforms have been fast-tracked, and we understand that this is potentially at the fear of losing elections and having to entice a different voter base. But the idea of coalition for us is exciting because it means that new blood gets inserted into cabinet. The reality is the ANC government and the ministerial posts that they implemented has really been stagnant in actually implementing the necessary reforms. So therefore, we really need some fresh blood to come into the cabinet in order to firstly fast track the reforms that have been implemented, but also come up with new ideas, because from a growth perspective, so much still needs to be done.
I mean, I guess they'll have to push through the reforms at the same time trying to unify the country. So what are the key priorities that you would like to be put in place by the new government?
So for starters, energy is one of the things that's very much topical and something that we need to sort out, because it's been a big lag when it comes to overall growth in the economy. The logistics sector is one that needs to be sorted. And then when it comes to employment, the necessary reforms when it comes to being able to bring in skills from different parts of the world becomes also important. And then from a national treasury perspective, which is something that's very important for us in the markets, we've seen progress from a national treasury perspective in keeping expenditure very low, and also being mindful that revenue is quite low. So what they've done is they've actually been successful through keeping expenditure low to implement a small primary surplus over this period. But we're mindful that introduction of more, I would say, populist policies such as NHI can actually set them back if we then implement those, if we increase that expenditure. So that's what is really needed from a policy perspective. We need the continuation, but we also need Treasury to be able to operate independently without having that pressure to push up expenditure, because growth is still a problem. And while growth is still a problem, revenue and us being able to increase revenue numbers will become an issue.
I mean, I know foreign investors have dumped some 52 billion rand actually of South African stocks so far this year. And I don't know whether that's really anxiousness on if there's a coalition, there's a number of partners that the ANC could partner with. Do you have a favorite coalition partner that would mean more pro-business and stability for the economy?
I mean, the reality is there are parties that just based on the policies that they've implemented makes it very difficult to see it being market friendly. So those are some of the opposition parties have named doomsday coalition tabs. So those are the coalitions we definitely do not want to see. So it all depends on what the ANC gets. So if the ANC gets the 42 to 45%, it means that it will be able to get into coalition with the smaller parties, in which case just handing them a few ministerial posts, it will be business as usual. But I do think another scenario that the market is potentially not appreciating is one where if the ANC actually gets towards the lower 40s, forcing it to go into a coalition with one of the bigger parties, such as the DA, for instance, and potentially the MPC. It means that the reforms it will force them to actually change more significantly than having a 45% and being coalition with the smaller parties and it's business as usual. We actually want a coalition that forces the ANC to sit down with the bigger parties and not just give them a small ministerial post and it's business as usual, but actually work with them to firstly fast-track necessary reforms and actually start implementing necessary changes where they're required.
Do you feel like assets are undervalued, and actually is a possible takeover of Anglo-American almost really a sign that assets in South Africa are cheap?
Yeah. I mean, if you look at the markets that I operate in, which is primarily in the fixed income space and the currency markets, just looking at the risk premium that's priced in local government bonds versus what we're seeing in our emerging market peers, the risk premium is significant. And it's really a function of the foreign investor base being cautious in coming to this market. We've had some conversation with some foreign investors, and that's the sentiment that's generally around. The risk premium, we understand there's fiscal concerns in South Africa, but when we look at the quantum of the risk premium, firstly, you're being rewarded way above the type of fiscal risk that one is taking on. So there's definitely a premium that is sitting in South African assets that could potentially unwind if we get a favorable outcome at the election.
When you look at some of the other things that we should be watching out for, where do you see the biggest opportunity? And is it, will it be difficult for a coalition or whoever's in power to, again, stimulate the economy internally, but also give foreign investors what they want to come in the country?
So the income space, as I mentioned, that's definitely the one area where there's a high risk premium that's been priced in them. And then just looking at our equity market, understandably, the growth situation in South Africa, the growth outlook is currently quite low. And therefore, the equity market, we understand that they need that growth stimulus to come through. So while we have growth concerns, there'll be this risk premium that's priced, which means that South African equities are also very cheap. So post-election, there's really an opportunity if we get the necessary work done from a post-election perspective to see that risk premium unwind. But we're mindful that in line with how the Constitution works and how long it takes for us to get to a point where we elect a president and him or she electing a cabinet, it can take some time. So therefore, it's one of those where, from a market perspective, just being familiar with the underlying policies of the political parties that will likely be in coalition, for instance, with the ANC, is something that will get, as a risk taker, put you in a better position to actually assess what the potential outcome could be when we eventually get a cabinet in place.
Nomathibana, thank you so much for joining us today. That was Nomathibana Okello, Portfolio Manager at Terebinth Capital. Coming up, the White House says Israel-Rafah strike does not cross the red line, despite French and German leaders calling for a ceasefire in the aftermath. More on this next, and this is Bloomberg. The conversations that matter, the insights you need. This is A Pulse, and I'm Francine Lacqua here in London. Now, Israel's army says tanks have reached the center of Rafah. According to AFP, residents have been reporting clashes between Israeli and Hamas forces in the center of town. Now, U.S. National Security Council communications advisor John Kirby says the White House does not support a major ground operation in Rafah.
We don't support, we won't support a major ground operation in Rafah. And we've, again, been very consistent on that. And the president said that should that occur, then it might make him have to make different decisions in terms of support. We haven't seen that happen at this point.
Well, let's get more on the story with Bloomberg's Bobby Ghosh. Bobby, thank you so much for joining us. I mean, there are a number of leaders, especially the French leader, that urged caution, that said what happened in Rafah, also in the camp on Sunday, was, I think his words, outrageous. Where are we on the ground offensive?
Well, as you just reported there are tanks in Gaza. There are Israeli soldiers there. There are Israeli news sources are reporting that the Netanyahu government is sending another brigade of soldiers into the outskirts of Rafah. It smells like a major ground offensive. It sounds like a major ground offensive. The question, of course, is how the White House chooses to describe the word major. I think in the White House's view, a very, very large number of soldiers, they haven't stated a number. A very large number of tanks, they haven't stated a number, would amount to a major offensive. There's a lot of leeway in the definition. Yeah. And Kirby sort of very quickly went past that word major. But at some point, if this offensive continues and Israel throws more resources into it, the White House will have to come to a reckoning about what point does this cross over into the realms of major.
But, I mean, we've heard from the UN, we've heard from the ICJ. There's really a public outcry from, again, major superpowers across the world for Israel to temper the casualties, the civilian casualties of what they're doing in Gaza. Is anyone hearing that call?
Well, the call that matters the most to Israel is the call from the White House. The United States is Israel's longest, closest, most important ally, and the White House's messaging has been ambiguous. As you point out, Olaf Scholz, Emmanuel Macron are openly calling for an outright ceasefire. The ICJ, the criminal court, has demanded a ceasefire and has told, in fact, ordered Israel to cease fire. But those are not the voices that matter the most to Israel. Israel has become increasingly isolated in the world over this offensive, and that process will continue. But so long as it has the tacit support from the White House, from the United States, I don't see any reason why they would suspend the operation.
So, Bobby, will a ceasefire only come on Israel's terms? And when will that be? Is it impossible to tell right now? We also hear, about one Egyptian soldier a couple of days ago being hit. It feels like the tensions in general are really high.
Yes. So the terms that Israel have set and the terms that the White House is supporting is that Hamas must be completely destroyed. But there again, it's hard to define. When do you say that a nebulous organization like Hamas has been completely destroyed? When all of its military leadership has been killed, but there are second, third, fourth tier leaders who are willing to step up. When all of its soldiers are killed, well, we may never know that because, again, by Israel's own explanation, these soldiers tend to live among the civilians and are very often indistinguishable from the civilians, which makes it very hard for Israel to target them very specifically without hurting and killing others. So these terms that have been defined are too vague for us to pin any hope on an end state, never mind an end date. The offensive will stop when Israel feels that it can withdraw from Gaza without threat of a recurrence of the events of October 7th, not just in the immediate future, but ever in the future. That's a very, very high bar given the circumstances.
So, Bobby, in this context, what is Iran doing? What is Saudi Arabia doing? We know that Qatar is also trying to mediate and negotiate, although there didn't seem to be much hope from the Prime Minister and Foreign Minister.
The Qataris have been trying to mediate. You and I were in Qatar a couple of weeks ago, and we heard the Prime Minister very directly say on the Bloomberg stage how basically he conveyed a sense of disappointment and almost and deep frustration that talks were not going anywhere. The Saudis are sitting on the sidelines, waiting and watching. They have indicated a willingness to normalize relations with Israel as bait, if you like, as a reward for a motivation for ending the operations in Rafah. But there's also a caveat there. The Saudis insist that there must be a plan for a Palestinian state. So, the folks around are in a state of watching now. The Iranians now have a very serious internal political crisis of their own. They were beginning to sort of explore the margins of sort of assaults on Israel. But now that the Iranian president has died, there is an election to come up in less than 2 months. There's a great deal of, I mean, the Iranians are distracted. They will probably still use their proxy forces. We saw just yesterday the Houthis in the Red Sea again hit a Western sort of tanker. So they will use their proxies, but they're not directly getting involved at the moment.
Bobby, thank you so much, of course, for the update. Bobby Ghosh there with the very latest on the Middle East. Now, coming up, the Chinese car maker BYD unveils a new hybrid powertrain that's able to travel more than 2,000 kilometers without recharging or refueling. More on that next, and this is Bloomberg. The conversations that matter, the insights you need. This is The Pulse. I'm Francine Lacqua here in London. Now, the Chinese car maker BYD has unveiled a new hybrid powertrain that's able to travel more than 2,000 kilometers without recharging or refueling. Now, to put that in perspective, it's a single trip from New York to Miami or from Munich to Madrid. Meanwhile, Volkswagen AGM kicks off today, where Chief Executive Oliver Blume is expected to face investor calls to sharpen the company's EV strategy. Well, joining us now is Bloomberg's global autos editor. He's Craig Trudell. I prefer calling you Autos Tsar, but we'll go with editor this time. Craig, when you look at, I mean, BYD, this is incredible. Like, without recharging, without refueling, 2,000 kilometers. Is this, first of all, really doable, and is this groundbreaking?
I think it speaks to the fact that they really see value in pushing the boundaries of what hybrids can do, given the fact that they are, competing on a quarter-by-quarter basis with Tesla for pure battery electric vehicle leadership. It suggests that there are still quite a lot of holdouts and really sort of puts BYD at odds with Tesla, which was kind of scolding the rest of the industry just on their last earnings. When they reported earnings last, they said, EVs are kind of taking it on the chin right now. Hybrids are having this resurgence. We think that's the wrong strategy. This really speaks to this idea that BYD feels differently.
But so are they working on anything else? And when you look at some of the things that are coming out of China in terms of EVs or hybrids, are they really winning the game?
They're dominant in this space in China. I think they're also really viewing this as sort of the way forward for them in a lot of export markets where EV charging infrastructure is not as solid as it is in China. In China, that's one of the big things working in the favor of EV uptake is the fact that you are able to count on a public charge. Throughout much of the country, it's not the case. Even in Europe. And so they're really, I do expect that to see them lean into this in some of the export markets where they have really big ambitions to grow.
Craig, what are you expecting from Volkswagen? So you have, the Chinese EV makers that are being supported are doing, quite well. You have a lot of support from the US, and then Europe is kind of stuck in the middle.
Yeah, the Chinese loom large over this meeting, I think, more so than ever. The fact that Volkswagen has lost its leadership position in China has been a big red flag for investors. I think, questions about, whether or not they can sort out their sort of do-it-alone software strategy. That's really held them back in terms of delaying new models. I also think it hurts, even once they've gotten those models out, they haven't been as competitive. They're glitchy. They're not as attractive as some of the other wares that are out there. And so they're losing position in some of their most important markets, and the stock price is feeling the effects of that. So we are hearing from investors who are a bit disgruntled with all the above.
Craig, thanks so much. Craig Trudell. This is Bloomberg.